Welcome to video number 11, Preparing Financial Statements, the basics of preparing financial statements. Let's look at our roadmap. We've done our transaction analysis and our journal entries and our T accounts. Now we can prepare the income statement and the balance sheet, okay? We're on the home stretch of the accounting crash course. Let's remember our accounting process. First, we understand and analyze transactions. We did that. Remember when transactions and economic activities occurred, we analyzed them and decided which accounts to increase or decrease? Well, we analyzed the transactions and then we recorded journal entries and we posted those journal entries to T accounts. Then time passed and we arrived at the period end. We recorded adjusting journal entries as necessary and posted those to our T accounts. And so we've completed the first three steps in this accounting process. Now we're going to do the final three steps. And the next step is we're ready to actually report our income statement, which is our income and expense accounts. So how do we do that? It's pretty simple. Once the general and adjusting journal entries have been recorded as journal entries and then posted to the T accounts, well, now we're pretty much done. We can look at our T accounts and the ending balances of those accounts can just be transferred over and placed on the income statement. They're ready to go. So for example, our revenue T account has $600 credit in it. We can just transfer this to the income statement and say, we earned $600 of revenue this year. That's just as simple as that. So that's how we report our income statement. We just take our T accounts for our income and expense accounts and we reflect them on the income statement. But we're not yet ready to record our balance sheet, to report the balance sheet, because our balance sheet's not going to balance yet, actually. We haven't closed our income and expense accounts into retained earnings. So I need to teach you about the closing journal entry. That's step 5. The closing journal entry, what does it do? Well, our income statement reports our operating performance over a period of time. So it reports it for a year. When the next year starts, we need to start back at 0. So we need to zero out our income statement accounts every year. So that's the first thing the closing entry does. It zeroes out our income statement accounts. For example, revenue has a credit balance in it, right? When we have revenue, it increases with a credit. Now we've got a credit balance in our revenue account. We need to debit that account to zero it out. Cost of goods sold is holding a debit balance because it's an expense. We need to credit that account to zero it out. So we're going to zero out our income statement T accounts. Now, when we do that in a single journal entry, that journal entry is not going to balance debit for credit. That's because our income is not exactly equal to our expenses, most likely, okay? So the plug in that journal entry to balance the debits with the credits is going to go to the retained earnings account. And that plug will be equal to the net income on our income statement. Once we post that amount to the retained earnings account, the balance sheet will balance. Let me show you what I mean. Suppose we just have one income statement account and it's revenue, and we need to record the closing entry for this company. Well, to close revenue out, it's got a credit balance of 600. To close it to 0, I need to debit this account by 600. So that's what I'm going to do. I'm going to debit revenue by 600. And to balance the journal entry, it goes to retained earnings. So I'll credit retained earnings for 600 because I need debits to equal credits. Now, when you post this journal entry to the accounts, this is posting the closing journal entry. It closes out revenue, doesn't it? Revenue had a $600 balance, then I debited by 600 and now it has a balance of 0. And that $600 credit is now sitting in retained earnings. So retained earnings went up by 600. And that's the effect of the closing entry. As soon as I record my closing entry, just like we did, now my balance sheet will balance and I'm ready to report the balance sheet. So assets, liabilities, and equity accounts can be placed on the balance sheet. That's this next slide. Once the closing entry is posted to retained earnings, the balance sheet will balance and the ending balance of the balance sheet T accounts can be presented on the balance sheet. So for example, one of my balance sheet T accounts is retained earnings, among others, right? I've got asset accounts, liability accounts, equity accounts. I can just go take the ending balance of all those accounts and place them on the balance sheet where they go. So this is just an example. For the retained earnings account, I take the ending balance and I just put it on the balance sheet. And it's as simple as that. And once I've put all my accounts on the balance sheet, I'll be done with it. So that's it. We've now understood and analyzed the transactions. We've recorded journal entries and posted them to T accounts. We did adjusting journal entries as needed and posted them to T accounts. Then we were ready to report our income statement, our income and expense accounts. Then we record our closing journal entry to balance our balance sheet, and we report our balance sheet. That's the accounting process. Now we're ready for another year. The balance sheet accounts are updated, so retained earnings is updated. All of the different accounts in the balance sheet are updated. Income statement accounts are zeroed out, and we're ready for a new year of hopefully lots of revenue and not too many expenses to be recorded in the next year. We can begin recording new journal entries for the following year. And that's what accountants are doing. In all these corporations, accountants are doing this year after year after year. They open a new year, they record journal entries, they report their financial statements, and they close out the journal entries for a new year. So that's the basics of taking your T accounts and preparing the financial statements, the income statement and the balance sheet. In our final video, we're going to go back to our exercise and we're going to use our T accounts to prepare an income statement and a balance sheet for our example company.